Hi, this is Randy Finney with the right side of the chart, and today is Tuesday, March 8th, 2016. In this video, let's take a look at the equity markets, U.S. equity markets, and some of the other things that are going on. A lot has been going on lately, and that's why I'm preferring to do most of this market analysis in video format, just because I'm able to cover so much more in the same amount of time that it would take to put together a ton of static posts and type up all my thoughts. As I'm doing that, on the same breath, I wanted to solicit any feedback from the site. I know there are probably, I know for a fact a lot of you work full-time jobs, and maybe you're at your desk today and wanting to catch up on what's going on in the markets, and you can't really watch a video. So give me a feedback, and if there's strong preference for more or less, fewer videos, more static charts and written commentary, I can try to work that in. The videos I'll always continue to do, but if you guys are looking for a little more written post, morning updates, things like that, just drop me a line and I'll be glad to incorporate that. All right, with that being said, let's dive into the charts. Lots going on. From the follow-up for the last video I did was on March 3rd, so a little less than a week ago, and what we're looking at here, at least in the intermediate term time frame, are these rising wedge patterns. This is the NDX 100 or the NASDAQ 100, the NDX, and a slight breakdown there. That green line, that's a key level. We defended it so far. Right now, I'm doing this video in pre-market. The futures down a little bit. They were down pretty decent, but they've rallied back up. It's about 10 after 8 Eastern time right now, so there's still an hour and a half before we open. Anything can happen, but bigger picture is, and I'm going to be clear on my thoughts. This is the time where these are the levels I've been waiting for. Talked about it, and in the last video, the last couple times, I've stated that the markets will do one of two things. These were well-watched levels, and I'll get to the S&P in a minute. But I said we'd probably either fall short or blast through those levels and take them out. And then in the last video I did a week ago, we were approaching that 1990 level. Everybody and their brother was watching on the S&P. I was more leaning towards a 2000 level. But I said as we approached 1990, we were at, I think, 1989 or something, just below it, and we'd probably punch through it, and that's what we did. So we've moved through it. The momentum has definitely been to the upside, and as most of you know, it's these high-flying, the low-priced, what I call dash for trash, the companies with cruddy fundamentals, they have been leading the way in the market. And some take that to be a sign as, good breadth participation. To me, this is just a late stage bear market rally, more than likely. And from this point on, I am going to continue to reduce my long exposure, which I've been doing pretty aggressively over the last week, and continuing to add into shorts. And I'm already net short at this point, and we'll continue that. And get probably pretty aggressively short here soon. From the longer term charts we'll get to in a minute, they remain bearish. That's the most important thing. I know that the masses have the tendency to get very bullish when the market rallies, as it has recently. It's just human nature, and people get bearish when the market drops. And I'm, very contrarian. I don't try to be contrarian for the point or for the sake of being contrarian, but there are times where you need to go with the herd, you need to follow the trend, and there's other times where you need to recognize things for what they most likely are. And to me, again, this is probably just a bear market rally. We're going to talk on the bearish sentiment here in a minute. Everything that I talked about before, which has really fueled this rally up until this point. And while it could certainly continue to, fuel the additional rally, additional upside in the market, I think the odds clearly at this point are skewed to the downside. All right, so let's dive into these charts. Here's a 60-minute chart, bullish falling wedges. Sometimes you can sit here and overanalyze the market to death and say, well, everybody got too bearish and there were too many shorts, there's too much put buying or recently in the market. Well, let's just play the charts for what they are. Sometimes, you can tend to either suffer from paralysis by analysis, where if you factor in too many things, you don't do anything, and you don't make any money. And I also want to say that I'm very much what I call my own trading style. I use this to make up a lot of terms. I'm an anticipatory trader. I anticipate turns in the market. I anticipate moves before they happen. I'm not a trend follower. I'm not a trend chaser. I like to get in front of trends and take breakouts, and then get out before that trend is over. And so that's what I'm doing here, is trying to clear out my longs and quickly at this point move over to a net short exposure. So these are bearish rising wedges. They're very clear. There's negative divergence on the 60-minute time frame. Just about any indicator oscillator you put up. There's the MACD, RSI, my custom histogram pair, the 1333 EMA on the 60-minute time frame. Prices are just starting to crack below that wedge. And even if they thrust back up inside it, that's a very small breakdown, not very impulsive, not really confirmed yet. But we're at that point where if this wedge is going to play out as a bearish rising wedge pattern, it will do so soon, because we're getting to that point towards apex around 70%, give or take. It can break 80, they can break 90% to the wedge or more, but this is usually about where they do break down. We're also at those resistance levels I talked about on the market, so why not? And as I mentioned before, this orange line here is the top of that trading range, that well-defined sideways trading range from late 2015. You can see it here. That's where I will continue to scale short up until that level, but not above it. The market has no business getting past here. Anything's possible. The markets try to fool the masses. So if everybody, if there's more people thinking like me right now, that this might be it and we're not going to get there, then we're probably going to get there. And if we do, then we'll probably punch up through it to fake out, run the stops. And I mentioned before, I don't know if you recall in the last video, there's that big gap up there, and this is where, this is my trading plan in a nutshell. Get short here. I am now net short, and I will continue to get shorter, for lack of a better term, more short, up until this point right here. And again, that's the bottom of that trading range from late 2015. From that point on, in my opinion, other than a very brief, whipsaw move up through there, the market has no business getting above that level if we are in a new bear market. Otherwise, this was just an ongoing correction in a longer-term bull market, and I don't believe that to be the case. There's just too much technical evidence supporting that the fact that a new bear market has likely begun. But we'll see. If that happens, we'll definitely reassess things and start repositioning. But that red line up there, call it 45.85 right there. That's where I start scaling out aggressively. I typically, when I'm positioning for a larger move, as I am now, for the next leg down, that's a swing trade move, I'm scaling in and I'm going to scale out. But I'll rapidly scale out, on each, on the moves above here. Let's say we get a break above that level. Maybe my first lot will be on a 60-minute close, and as we continue to go higher each day, the new highs in the Nasdaq wouldn't be far above that. So at that point, if we go on to make new highs, that would be the ultimate bull trap scenario. To see the markets, particularly the Nasdaq 100, go on to eke out a new high, last for a couple days, and then collapse. And if it does, I jump back in. No big deal. But if we go on above this level, I'll start being out, and by the time we make new highs, if we do, I will be either a market neutral position. That means either fully cash, equal shorts, equal longs, or possibly even long. We'll see. We'll take that as it comes. So right now, that's all. Anything between here and here, to me, is noise, and it's just a reason to scale in. Now, I'll also continue to scale on the downside. There's many scenarios. We can trade sideways for a while. We can go up, and I'll continue to add up until that level. Or we can go down. Now, I favor downside break. These are clean rising wedges. And again, I don't want to overanalyze things here. Keep it simple. These are the levels that I looked for a long time for the bounce to go to. We're there now. We did that little, fake out, push above 1990. We're around 2000 on the S&P. Let's take a look at that real quick. See, there's 2001. We closed at 2001 yesterday on the S&P 500. And that was my number all along, was 2000, and a lot of people watching 1990. Either way, they're similar. You can see there's a nice line there, a nice level at 1990. But I said as we got to 1990 on the last video that my take is we're probably going to push through it because we were so close and the momentum was there. Now this little thing up here, let's try to draw this out here, is a what I call refer to as a wedge overshoot, and that's one of my favorite patterns in trading. When you have a bearish rising wedge. And it works the same on a bullish rising wedge to the downside. But on a bearish rising wedge, when you have right about the point that wedge would normally break down, when you have that impulsive thrust up and out of the wedge, when I'm on alert for, I'm not going to load the boat on it yet, but I am on alert for the possibility of a nice sharp move down. That's a wedge overthrow where all of a sudden prices shoot upside to the top side of the wedge and then quickly and impulsively move back down. That's been my experience. They don't just meander their way down gradually. They just come down pretty impulsively. So that's why I think this is a pretty good time if you're aggressive, because this is counter trend trading. The trend, the near-term trend, all the way since early February is clearly up. Now, longer-term trend indicators remain bearish, and that's why I'm okay to I see no reason not to play these bearish rising wedges for what they are, especially the fact that the markets are now at resistance on the longer-term chart. So there it is. There's all the divergences on the S&P. And again, factoring in the bigger picture, which I've covered a lot, and if this video has a little time at the end, I'll touch on those real quick, but that still remains bearish. And so the way I look at the markets is this would be a catalyst, if you would, possibly for a much larger move. If this could spark the next big leg down, and I know I've had questions from a lot of you that you're full-time jobs, or you're just not a very active trader. You just want a position for a big move if this is a new bear market. Well, that's how I would play this. And what I mean by that is normally a bearish rising wedge pattern. Let's say we were in a bull market or an uptrend, primary uptrend, or even a sideways market. This line I have here, it measures the largest distance of the wedge, the largest part of the wedge. And you would simply add that to where prices break down, and that would be your projected target. However, again, being where we're at, I think the breakdown of this wedge has the potential to be the catalyst to spark the next leg down. Therefore, I'm not looking for a drop from 2,000 down to 1,900 in the S&P. I'm not looking for that 100-point drop. Maybe that's all we get. Maybe we don't get anything. Maybe it breaks down and we stop short. But that's where I'm positioning now. So if I get short, as long as the markets confirm, I'll continually monitor the short positions, monitor the market, monitor all types of metrics, market breadth, sentiment, everything else, and then make the decision if I decide to cover some shorts. And you guys know me, I'm an active trader, so I do micromanage positions. I wouldn't, me personally, if I shorted here and we're dropping another 3, 4, 5, 600 points or whatever it is on the S&P before all is said and done, I'll certainly game a lot of these counter trend bounces when we get oversold to key support levels, but I don't recommend that for the longer term, less active traders. They might be able to get some shorts here that they can hold on for the next few months or more. Okay, now let's talk sentiment for a little bit, because I think that's the biggest thing. I really harped on that recently. Then I'm sure it's out there, and I'm sure you've heard it from other sources how bearish everybody became recently. Both on the a lot of people just refer to the sentiment surveys. I probably put the least amount of stock into those because that's talk. CPC, put call ratio, short interest. That's you can tell where people are putting their money where their mouth is. In other words, bearish sentiment polls. Who knows what they're saying? Maybe they're saying they're bearish on the market, but they're not short. So again, sentiment polls are just similar to those. What do they call it? The political polls, to see, those are usually not very accurate. what people say and what they're actually going to do and who shows up and votes. So anyways, this is the CPC. I've talked on this one in detail recently, so I'm not going to do too much again. This is that red line down here. That is the extreme bullish sentiment right there, and I have a red line because that's your sell signal. These are very rare signals. I've pointed those out before. The blue arrows show what happened after we hit those levels. This was the bear market back in 2008. We had a tag there, and that was followed by a 55% drop. These occurred during and early into the previous bull market, or what might be a current bull market. I shouldn't refer to it as the previous bull market, bull market yet. But there's a 17% drop and a 21% drop, lasting several months. And again, that only played out, when I say only, for a 21% drop, because that was during, in the early to mid stages of a new bull market. Now, based on everything else that I've talked about, and I don't have time in this video to go over the whole longer term scenario, or a longer term case, I should say. But we had this 1, 2, 3 triple tag. That's what I call a cluster. I really treat those effectively as one reading because they came close, but there is a lot of significance in the fact that we had not one but three in very close proximity. And so far, that has marked the top. I pointed it out at the time back on May 13th, and that market topped, if I'm not mistaken, it was May 20th when the S&P 500 topped of last year. So very well, that's just one of many things. Now, I also talked about this green line up here. This is when bearishness becomes excessive. And what I did, the dotted lines, the vertical lines, mark those readings. And again, I went over this recently, and this is why I have been bullish, because we hit that extreme. Those extremes are rare. They've even come in the previous bear market. And even back then, as I highlighted before, they led to significant rallies. We usually had, a successive low, a slightly lower low a few weeks later, followed by a big rally. It happened here. We rallied a little bit, had a lower low, and another rally. So again, these readings have led to bounces, and in my opinion, taking everything into context, so the larger picture, the fact that the longer term charts point to the fact that the bull market has likely ended, that tells me that this bounce is enough now to clear out that excessive bearishness. And that's really the theme I'm trying to press today. So I think that we had that run, and I think right here, I always have this theory, and this works as well with these sentiment surveys. When you hit these extremes, sometimes the damage is done, and right here we hit such a bullish extreme. I think that damage is more lasting than what we've seen, more lasting than just this or this right here. So that's the CPC I just wanted to point out. Oh, and the other thing I wanted to point out, of course, look at the reading back in 2008. Last time we hit that level in the early in on that other bear market. You can see from that point that we never hit that level again. So I'm not looking for another tag. Next time we hit that level was all the way in 2010, well after the bull market was underway. You can see this 55% drop, and you can see how those levels never came. They approached right down here, and that's about where we are right now. Look where we're at. We're at point. It's up here. Point 0.6585. I'm sorry, I'm not zoomed in. Okay, 0.85, and that's about where we were back here at this point in time. So if you look at it, it really looks very similar from that time we had that tag, that green level there. And that's about where we are right now. So this is normalized, in other words, the put-call ratio. And as I said before, when I'm using things such as these sentiment measures, I only use these extremes when they hit these extreme levels. Everything else in between, in the middle, from this red line down here to the green line up here, that's all noise. And I just, it's my belief that you can't extrapolate any useful value from these ranges, as well as the regular sentiment polls that are out there. So I would love to wait till tomorrow to do this video, but I know there's a lot going on in the market now, so I wanted it out. I just wanted to point out that the short interest data will be out, released tomorrow. The dissemination date, it comes after the market close tomorrow at 4 p.m. You can see down here, March 9th. And that will be through, that covers the short interest for the last 2 weeks of the month. Remember, short interest, and one reason it's really hard, especially for retail traders to use. I've always suspected that the institutions with a lot of money can buy access to this. There's no way in this day and age of this computer-run world that we live in that the firms have to report the short interest. That information is due 2 days after the month closes out. So last of February was 29th. That all that short interest is due by March 2nd. Yet we're still living back as we were in the 80s and 90s, where it takes them a week to process and report that data. So unfortunately, we're retail traders. I've always suspected. I can't prove it. I don't know if it's out there. The big firms probably know how much of that short interest has been cleared out. But we won't know, fortunately, until tomorrow after the close. And again, that short interest period ended on the 29th. It actually began mid-February. So you're talking 3 weeks after that, the beginning of the period, 3 weeks after, and a week, more than a week after the period closed out. So it's a little dated by the time you get it. And what I've always done, I've just had to use my skills of observation, watching the market, watching what's going up, looking at the high short interest stocks, seeing them, and try to extrapolate how much of the recent buying was actually genuine long stepping in, especially not just traders. Traders will buy a long, like I have, to flip it and ride the wave and then get back out. I had no interest. I had planned to hold Mosaic, Potash, some of those Pier 1, some of those growth and income trades for months if the market held up, but they all ripped up so fast and hit my profit targets, and that's trading. So I think like I said, I'm out of nearly all of those positions. I reduced, sold all Pier 1, closed out most of those. But anyways, that's my point, is that was I think largely a short covering driven rally that we had recently, as well as momentum traders like myself on the long side, as well as a lot of institutions. And only time will tell, but I don't think it was genuine buying. In other words, strong hands. Strong hands are people that come in and they're looking to hold those stocks for 6 months, a year or more. And I just don't think, but we'll see that soon enough. And here's the sentiment survey. This is the link on the home page under Tools of the Trade. This is the AAII sentiment survey. And as I said, I think, again, I use the case the damage was done. Everybody talks about, as I did, how recently, or how large the bearish sentiment ramped up. We've seen readings that we haven't seen in many years, if at all. I mean, we had nearly a 50% bearish. 50% of traders surveyed were bearish, 48.7% versus only 19%, and you rarely see those. So that was an extreme. And that was also back on February 12th, and we've had a heck of a rally in spite of poor longer-term technicals. However, the short-term technicals confirm that rally, every bit of it. So the million-dollar question is, was the rally that we just had enough to clear that out? You can see the bearish sentiment quickly abating, dropped down from 40 to the last reporting period on March 3rd. And remember, today's March 8th right now. So, we'll have, in a little less than a week, we'll have some more data out. But the bearish sentiment has now fallen back to a level of only 30%. So there you have more bulls out there right now. Still a pretty large number neutral. But so I know my point is, I think that's certainly enough to have cleared out, especially if these numbers drop again next week, as you'd have to almost expect they would, based on the market rally. A lot of people are just, again, tend to be contrarian, at least at certain points. And unfortunately, you can just plot these to the market, and you'll see that when the market drops, back on February 12th, that's when the bearishness is really extreme. And when the market rallies, everybody wants to be bullish. So here it is. There's this is going back to that 60-minute S&P 500 chart, and let's put my cursor there. It is. There's the 12th right there. It was the day after the 11th. They took that poll on the 12th, right at the divergent low. That's when the S&P, made that big, beautiful divergent low. We were able to go long there. We went long again here because the technicals confirmed, and so did the sentiment. So we had excessive bearishness. And there's my point. You can reference the site. At this point, I was bullish and long. And you can see from those sentiment surveys that we had the highest number of bearish traders and investors in decades, if I'm not mistaken, at least in many, many years. And that's just, the nature of the game. And, you want to be buying when everyone else wants to sell. You want to be selling when everyone else wants to buy, but only at those extremes. Not, you can't just fight a trend, say everyone was bullish here, so you want to start selling. No, now is the point where the technicals confirm, and more than likely, we know for certain that the bearishness has abated quite a bit. So you have the markets. That's the big picture, folks. I won't go on much more about it. You have the markets at key overhead at or just below key resistance. You have long-term charts still bearish, long-term trends still bearish, and you have these in the near term, the intermediate term. And this is what I've talked about. Somebody asked me the other day, they're a longer-term trader, and they asked what time frame should they focus on. I said, disregard anything under really the 60-minute charts. What you want to do is use the monthly and weekly and daily charts to formulate the big picture where the market's going. And then as far as swing trading, what I do is I'll use the 60, sometimes the 30-minute charts, but usually the 60-minute charts to hone my entries. So in other words, the longer-term charts have been telling me, get ready. This is probably a bear market rally. Get ready to short it for the next leg down. However, you don't want to short it too early. You just get crushed in these rips, especially if you were short any of the, the small cap stuff, the lower quality stocks that we've been trading long recently. And that brings me to my final point. This has been, as I suspected it would be, and I think it will continue to be, a stock picker's market, unlike the previous bull market, which was a buy and hold market. You could have put all your money in the Qs or the SPY and just sat back and slowly but surely made money almost every day. Right now we're seeing a tremendous amount of sector rotation, and even within sectors we're seeing certain stocks do well and others do poorly. So that's where the opportunity is right now, trading individual stocks. I know a lot of you don't have the either the skill sets or the desire to trade individual stocks, or maybe not the risk tolerance. There is some, there's certainly diversity and a little more safety in the fact that ETFs are diversified. My preference going down the next leg, I've only put on the Qs in the small caps right now just to get some exposure. And actually, I do have a couple individual stocks, I should clarify, and I've posted those. I've shorted a couple recently. And I'm going to continue to look at the most bearish sectors and the most bullish sectors going forward. If we are in a new bear market, and even if we're not, I always trade long and short. At almost any given point in time, I have longs and shorts in my portfolio. So this market can go to hell in a handbasket, and we'll probably see gold continue to go higher. There's one example. Commodities have been beat down. As most of you know, that's been my focus recently. So I think that'll be the theme going forward for 2016 is bearish equities, or at least the broad markets, and looking at select commodities, maybe not the entire arena, because all commodities are not created equal. There's many different types, and focus on the most attractive, most bullish sectors and the most bearish sectors to go long and short. And I also have been, leaning towards a lot of the dividend plays, especially for my longer term accounts. And I do plan to replenish the growth and income trade ideas. We just had so many, everything I put on there since this year started has just exploded to the upside and already hit the profit target. So it's ironic. I bought those, largely for the dividend, and most of those haven't even paid out a dividend, and they've already hit their profit target. So let's see what else. I think that's it. I'll wrap this up by saying this to give you some more actionable trade ideas. I'll be more specific. Until I get some more official short trades out there. I've put up some ideas in the trading room. But if I am correct on this and these bearish rise and wedges play out, even if they don't play out for the next huge leg down, even if they only play out, let's say a correction, markets pull back 5% or so, what I think you'll see very likely is all that low priced, low quality second, third tier stocks, those ones we've been just killing on the long side lately, those will come down so fast that your head will spin. So that's what I'm looking at. I'm keeping a close eye on the shippers. You've got to be careful. It's just like shorting the miners, being on the wrong side of the trade. Those things are brutal if you're on the wrong side of the trade, long or short. However, as I mentioned yesterday, I took a position in one, and as soon as we see some evidence of the markets cracking, I'll continue to short more. Energy is another story. Oil's broken out. That's pretty strong. Got to be careful now. Those are counter trend trades, and they're early in the early stages, and you're seeing some explosive gains to the upside. However, when those stocks get really ahead of themselves at resistance, and you can stay away from the energy sector if you want. There's a dozen other sectors or more out there that have had these big explosive moves. But if you really want some quick gains in short order, instead of shorting the Qs or the SPY, and I wouldn't advise a SPY. I'm leaning towards, if you've noticed, it's not been coincidental, the small caps in the Nasdaq 100. The Qs, because those are your risk on indices. So when risk is on, they do good. Small caps, the Nasdaq 100, because all the tech companies. When it's a risk-off market, what happens is the S&P 500 will almost always fall less than the NASDAQ 100 because it has a lot of dividend-paying stocks, because it's more diversified. It represents just about all the sectors of the economy, such as financial stocks, which the NASDAQ 100 doesn't have. So you have dividend-paying stocks, utilities, you name it, they're all in the S&P 500. And so it tends to move up slower in a bull market, and it also tends to fall less. So that's my preference now until I can build up a portfolio of more individual names via individual stocks and sectors. So again, if you're nimble and aggressive, I'll post some of those in the trading room. Some might be official trade ideas, but look for those high flyers recently that have just exploded. The stocks with lousy fundamentals that are up, 30, 40, 80, 200, 300% up into resistance level. If the market rolls over, then those things will come down pretty darn quick. Okay, and this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.